I start proceedings by acknowledging that we gather together on the lands of the Wurundjeri people of the East Kulin Nation, custodians of the land for 1,000 or more years. We acknowledge also the country that those of you online are joining us from. And we pay our respects to elders past, present, and emerging. So we've been waiting for this event for quite some time. We were just discussing before why it got shunted almost a year, and as we do, I'm sure we can blame COVID for that one. But here we are, and you all know what we're here for. We're here to think about some of the challenges that our nation is facing in the here and now, in the short term, in particular, cost of living and high interest rates, and the real pressures that many are feeling across our nation. But we talk also about some of the longer term challenges facing the country and how we need to keep an eye on the future and the reforms to our institutions and to our policy settings that will improve our competitiveness, our productivity, and create shared prosperity for all. Finding that balance is never easy, but particularly now, global tensions, supply chain issues, and climate change, of course, making the task even harder. But as you all know, and the reason you're all here, we have with us today a speaker who is probably unmatched in the country to talk about just how you do strike that balance. Before I introduce him, let me just indicate we're going to have about 30 minutes for the moderated discussion. And then we've certainly got time for your questions and participation. There'll be just the usual way of raising your hand and speaking up, but equally you can use Slido, which I hope many of you are familiar with. So if you've got a smartphone or an iPad or a tablet of some kind, you can just scan that code, QR code on the screen, and enter your question when the time comes. I'm also pleased to introduce you this morning to someone who some of you may have met, but perhaps not many of you, and that's Professor Phil Dolan, who is the Executive Director of the Institute for the Future of Business here at Melbourne Business School and with the university's Faculty of Business and Economics. Following completion of his PhD in financial economics at Stanford Business School, Phil worked for over a decade in investment banking at Macquarie Bank. He's been the head of the Department of Finance and Actuarial Studies at Macquarie University and also the Dean of the University of Western Australia Business School. Without further ado, and he doesn't need much introduction, but I will say a few words in welcoming the Honourable Peter Costello AC. He is, of course, one of Australia's most experienced government insiders and business leaders who's going to provide us with these unique insights on the way forward for Australia. Peter was our longest serving federal treasurer, and he now chairs major Australian media company Nine, and he's also the chair of the Australian government's Future Fund investment arm. From 1990 to 2009, he was a member of the Federal House of Representatives and treasurer from 1996 to 2007. Delivered 12 federal budgets, amongst those 10 delivering a surplus. And during this period, our sovereign credit rating reached a AAA rating. Peter set up our system of financial regulation, establishing the Australian Prudential Regulation Authority, APRA, and the Australian Securities and Investment Commission, ASIC. He also established the Takeovers Panel. In 2006, after government debt was eliminated in net terms, Peter initiated the Future Fund, thinking about the future, and from its original deposit has now grown to a value of over 200 billion. He now chairs that fund, and he's also served on the IMF committee as chairman of the global group of 20 finance ministers and central bankers, the G20. After leaving politics, Peter joined a number of international and domestic boards and was chair of the Independent Advisory Board to the World Bank. So with those credentials and experience, I think without further ado, let me welcome you, Peter, to the perch, together with Phil, for your conversation.
Thank you very much. Oh, good morning, everybody. Thank you for the introduction, Coron. As Coron said, if you could please hold your questions until the question time, and then we'll call upon you in the usual way. It's a pleasure to have Peter with us this morning, given his experience and insights from career, both in politics, but since then as well. The questions I'm going to ask will draw upon both those careers, as it were. To begin with, over the last couple of years in particular, we've seen a much greater focus on the activities and decisions of the Reserve Bank, to the point where the lead story on the news is often that the Reserve Bank raised interest rates. Sometimes the lead story in the news has been that the Reserve Bank has not raised interest rates, which tells you how important that's seen in the general public. A large part of that, of course, was because of the decisions taken by the RBA board during COVID, where interest rates were effectively reduced to zero. There were also some comments made by the former governor of the Reserve Bank during that period about the likely path of interest rates out some years, in fact, into 2024. Given your time as Treasurer, Peter, I wonder if you could comment on that period, in particular, monetary policy decisions that were made during that period, and what kind of job you think the RBA did.
Well, thank you very much, Phil, and thank you, Coron, and thank you for coming out on this early morning. I do have some views on the RBA, as it turns out, and I think the genesis of this conversation might have been that I was quite critical of the RBA monetary policy in the lead up to COVID, and I expressed them to one of your faculty, who was on the RBA board, and
is not with us today.
And your faculty said, "Well, you better come up to our business school and explain your case." So I'm very pleased to be here. So let me go back, and I'll try and enunciate where I think the RBA went wrong. If you go back 7 years to the appointment of Phil Lowe, whose term has just finished in the last this week, I think. When Phil was appointed, the cash rate was 1.5%. And for 32 months, there was no movement. In fact, it used to be a bit of a joke. When's Phil going to make a decision? And the board for 32 months left the cash rate at 1.5%. And then, because inflation was below 2 to 3%, the official target for monetary policy, there were a couple of reductions. And then by the time we got to COVID, which was March of 2000, the official cash rate was 0.75%. Now, my criticism was, I thought during that period in between the financial crisis of 2008 and COVID 2020, we should have been normalising rates. A 1.5% cash rate is not a normal interest rate. And my argument was that we needed to be normalising and, if you like, putting a few bullets in the locker so we had the ability to cut rates should another crisis come upon us. And we did not do that. So by the time we got to COVID, we're at a cash rate of 0.75%. Wasn't much to cut. Eventually, during the COVID crisis, the bank cut to 0.1, but that's 65 bips, 65 basis points. It's not much of a stimulation. We didn't have much to give away. So I thought the bank was laggardly in that period before March 2020. And as a result, when we went into the next crisis, and there's always a crisis, believe me, there's always a crisis in financial markets, we didn't have much left in the locker. So the bank had to start thinking about what we call non-conventional means to engage in stimulation. Didn't have much to cut by way of rates, so we needed a few non-conventional instruments. And for the first time ever, the Reserve Bank did two things. It did what's called forward guidance. We'll not only tell you what the cash rate is now, but we'll tell you what it's going to be in the years to come. And it did bond buying, started buying bonds on financial markets, sometimes called QE, quantitative easing. So the bank had never done this before, hadn't been done in Australia. We had no experience. In fairness to the Reserve Bank of Australia, most of the other banks around the world, led by the Federal Reserve in the United States, were doing the same sort of thing. And we went down this path. And it was because of so-called forward guidance, I think, that we got into another problem. The forward guidance that the Reserve Bank gave was that it could see the cash rate of 0.1% staying that way until 2024. It's giving forward guidance. Not only are rates low now, but they'll remain low. So get out there and borrow. And they saw that as a stimulatory thing. They wanted to give people confidence to borrow now so that you could take out as much as you could afford at this extraordinarily low rate, and that would stimulate the economy. And so the forward guidance was that we think we can maintain the cash rate until 2024, first point. Second point, not only did they say that, but in order to back that effort up, they started buying 3-year bonds to produce that outcome. So you would buy a bond that had a 3-year term at a price which gave it a yield of 0.1%. So we're backing up our words with deeds in the financial markets. And of course, the Reserve Bank bought the April 23 bond and ultimately the April 24 bond at 0.1%. All very well if interest rates in 23 and 24 are going to be 0.1%. But as we now know, the cash rate, we're only in 23, we're not even to 24 yet, is now 4.1%. So if you were buying a bond at a price that gave it a yield of 0.1%, and bonds are now at 4.1%, you've lost a lot of money. So not only did it go into the market to try and produce that outcome, but lost a lot of money doing it. And anybody who followed the Reserve Bank on the 3-year bond lost a lot of money along with it. In fact, the bank lost out so much money on those bonds that if you were to mark them to market, it has blown up its equity. The whole equity of the bank has been blown up. A commercial bank, the bank will now be insolvent. This is a government-owned bank. It's not going to, well, it has marked to market, but it will hold those bonds. It will deny the government dividends and it will try and rebuild its capital. Now, you've got to think about that. The government doesn't get the dividends out of the Reserve Bank of Australia. We, the taxpayers, are all poorer. So we will suffer. That was a bad financial call. They made the call that they could hold rates till 2024. They backed it up with bond buying, and in the end, on a mark-to-market basis, lost a whole lot of money. The taxpayer will be denied dividends. It was not a good chapter for the Reserve Bank of Australia, and in fairness, it's admitted that. So what do we do? The bank has done a review. It says we didn't properly communicate our forward guidance. I think it's a bit worse than that. I don't think it was a communication error. I think it was a fundamental misjudgment. We'll hold on to these bonds. We'll deny dividends. We will try and rebuild the capital of the bank. And in the midst of this, the government announces that it's going to do an inquiry into the Reserve Bank. Inquiry has reported the Parliament may well be legislating on the back of those recommendations this year. Now, I would say to you, there was nothing wrong with the mechanism or the arrangements that applied to the Reserve Bank. I don't think the target was wrong. I don't think the structure of the board was wrong. I don't think the number of meetings that they were having in the course of the year was wrong. I think it was just a failure of judgment. That the bank thought the COVID hangover would last a lot longer than it did, that therefore interest rates would continue to 0.1% into 2024, and the recovery was a lot quicker than they expected. And that's a good thing, actually. That's a good thing, that the recovery was a lot quicker than they expected. But there were execution mistakes that were made along the way. So I would argue strongly there was nothing wrong with our arrangements. It was the execution that failed. And so I'd say that the inquiry, which has come up with all sorts of recommendations, which I can go into, and I'd be very happy to go into, really, if it was looking at the mechanics and the machinery, it was looking in the wrong place. What it should have been doing was looking at the execution of the bank, which the bank itself says it failed in respect to forward guidance and the bond buying program. So we now have this inquiry, and the inquiry has recommended some mechanical things. For example, let's have 8 meetings of the Reserve Bank Board a year rather than 11. Does it matter? No. Let's have 2 boards, one that can focus on monetary policy and one that can focus on governance. Was that the problem? Would that have avoided this particular area? I don't think so. And it has made one recommendation, which I think is going to get us all into trouble, which is in the conduct of monetary policy, rather than having a single inflation target, which is 2 to 3% underlying, which was the target I put in place back in 1996. They want to have a dual target of an inflation target and a full employment target. Now, that does make a difference. And I think the dual target will take the bank's eye off what I think it can and should focus on, producing an inflation outcome with a dual mandate, which I think will confuse the direction and will confuse observers as to the direction that monetary policy is going. And it's very important when you're running a central bank that you are communicating very clearly, because investors are taking decisions every single day on the basis of what they think the conduct of monetary policy will be. And I think it needs to be clear. I think the inflation mandate of the Reserve Bank, the 2 to 3%, was the right one. I think the Reserve Bank should have a clear inflation focus. I think to the extent that you introduce other objectives, you leave open a confusion both to the bank itself and to investors. But I don't think that will make our monetary policy better. I think it was a failure of execution. I don't think it was a failure of the arrangements, and I think it would be a mistake to change the arrangements to deal with an execution failure.
Thank you. Staying on the Reserve Bank and the review, when you were Treasurer, one of the things you did was to establish a principle of Reserve Bank independence, which has served Australia very well and has since been copied very widely around the world. Do you have any views on how well you think that initiative will hold up going forward?
Well, I think it's important that a central bank is seen to be independent and is independent. Probably can't be seen to be independent if it's not independent. So it's got to be independent. It's got to be seen to be independent for the reasons I gave before. See, people are in financial markets every day. They're buying, they're selling. They need to have a clear idea what target the bank is working towards, because that gives them a clear idea as to how market pricing will be operating. So I think that's very important. And they need to know that the government won't be behind the scenes trying to manipulate monetary policy for political outcomes. So I think independence is very, very important. You would all agree, I'm sure, that it's very important to have an independent judiciary. You shouldn't have the government, around the back talking to the judges, telling the judges what sort of decisions that they should be made. And I would say similarly, it's very important for a central bank that it be seen to be independent. You don't have the government sort of around the back saying to the central bank, what about this, what about that? It's very, very important that it be seen to be independent. And I think, this means that you need robust people who are committed to an independent objective. And that's why I think central banks are best when they've got an inflation objective, as we currently have. Query whether it will continue if the mandate changes under the recent review and proposed legislation backed off the recent review. So very important. But I've always said, just because you're independent, it doesn't mean you're infallible. Right? Independent people can make mistakes. So it doesn't mean just because the central bank is independent, every decision it's made is therefore right. And when I was critical of the bank in that period before COVID, people said, "Oh, you shouldn't be critical of the bank, you'll undermine its independence." My argument is anybody's entitled to talk about monetary policy. Just because it's independent doesn't mean it's infallible. I think it's making mistakes. I think the bank itself has acknowledged that it made mistakes, but I respect its right to make them. It's like a court of law. Sometimes courts get things wrong. They're independent, but they're not infallible. So you have an appeal mechanism in a court. You hope that superior courts can correct errors that occur. The thing about a reserve bank is there's no appeal mechanism, of course. Right? So you can't take it to the appeal board of the Reserve Bank and say that rate rise was wrong, or that rate rise was shouldn't have happened, or should have happened, or whatever it is. You live with the decision, and it can correct its mistakes over time. So independence, yes, absolutely. Infallibility, never had it. And that's why I think you do have to have a lot of scrutiny on an institution that has enormous independence and enormous financial influence. A lot of scrutiny. And I would say to you, I don't regard the scrutiny on the Reserve Bank of Australia as out of whack with international practice. I would say to you, I think the Federal Reserve in the United States is probably under more scrutiny than the RBA. Its decisions, of course, have wider effect because they tend to influence not just the United States, but the global economy. So I would say very important that there is scrutiny. I would say to the media, there has been, I think over the years, a bit of reluctance in the media to engage in critical scrutiny of the RBA. I think the media has to be respectful scrutiny, but it's entitled to have critical scrutiny. But we all need to agree, and I think we all do agree, I think the current government agrees, that we have to maintain the independence of the bank. If we lose the independence of the bank, we lose a lot more than we would ever gain.
Now, a couple of other initiatives that you're responsible for were the Productivity Commission and the Intergenerational Report. Both of those have produced reports recently, which have gone to government, and both of them made some recommendations with regard to boosting productivity, improving welfare generally, prosperity, and so on. But there seems to be a lack of appetite to take on at least some of those recommendations. Based on your own experience, and not just those initiatives, but things like the GST and so on, that when you were Treasurer, where there were some really major policy reforms, what advice would you have for those who see the need for this but are struggling to build the necessary public support and coalition to make them actually happen?
Yeah, well, I think this feeds back to monetary policy in a way. Structural reform is hard. Let's take the hardest structural reform, tax reform. I can tell you, I introduced the GST, which took effect on the 1st of July 2000. That was hard. That was hard. Because not only you have to work it all out, but you have to get a bill through the House of Representatives, and then you have to get a bill through the Senate. And whilst you're doing all that, you have to get re-elected. And that is hard. Monetary policy, comparatively, is easy. You just call a board meeting and you say, we'll lift interest rates. You call a board meeting and say, we'll cut interest rates. You don't have to have a bill. You don't have to put it into the House of Representatives. You don't have to put it in the Senate. You don't have to run for election. You just do it. And because monetary policy is a much easier and quicker lever to pull, I think monetary policy, I'd say since the financial crisis of 2008, has become the preferred lever of economic policy. Very easy to pull, doesn't require legislation, works pretty quickly, but it's a blunt instrument. That's the problem. When you raise interest rates, you affect everybody. It's a blunt instrument, big instrument, but it's a blunt instrument. And I would say, not just in Australia, but around the world, and again, principally the Federal Reserve in the US, monetary policy has been given enormous weight because it's the easiest lever to pull. United States Congress deeply divided, very hard to legislate anything. So we'll let the Fed either stimulate or contract the economy. I think here in Australia, we gave the responsibility to the Reserve and stimulation 2008, which we never really got out of, and the stimulation to 2020. And comparatively, structural reform, what I'll call structural reform, microeconomic reform, is much harder to pull. And I think we've got to get back to that. Interestingly enough, Phil Lowe, the outgoing governor of the bank, said in a speech, probably his last speech, we've got to raise the productivity agenda, which I totally agree with. But you see, the productivity agenda is going to require legislation. He's basically saying to the politicians, you've got to do more. You've got to carry more of the weight. We at the bank can't carry all of this weight. He's right about that, in my view. So why don't they carry more? Well, I'll tell you, it's just much harder. You've got to get yourself elected. You've got to figure out a bill. You've got to get it through the House of Representatives. You've got to get it through the Senate, and then you've got to be re-elected at the end of all of that. The one advantage Phil always had was he never had to get elected. May not have been reappointed, but he never had to get elected. So I think that's right. And I think the outgoing chair of the Productivity Commission, Michael Brennan, said much the same thing. There is a big productivity agenda there waiting to be done. It's just hard work. And the problem for Australia is that our productivity growth has been in decline. The growth has been, since the 1990s. In the last year, it actually went negative. So declining growth in productivity and now actually falling growth in productivity. This is a big problem. A famous saying by the US economist Paul Krugman says, productivity isn't everything, but in the end, it's nearly everything. Productivity is what boosts living standards. And that comes back to our 3 Ps. So I'm happy to go into it.
Yeah, please. Well, let's stay on them. Productivity, participation, and population were the 3 Ps you identified over 20 years ago. As you've said, productivity is waning. Do you still hold to that view? And if we are trying to do something about improving productivity, and we've had a report that has some pretty good recommendations, as you said, what should we be doing about it?
Yeah, well, when we brought down the first intergenerational report in 2002, we were trying to explain to people the long-term structural drivers of an economy. And it's just a sort of handy way of remembering them, 3 Ps. Population, participation, productivity. Population, the number of people in your economy stands to reason. The more people you got, the bigger the economy. Participation, how many or what proportion of those people are participating in the economy, in the labour market, contributing to the economy. Big factor. Productivity is how productive are those people that are participating in the economy. Now, if you look at Australia at the moment, we've got a very big population growth, which is growing the economy. It's not growing the economy per capita, but it's growing the economy. So overall, the economy grows. Doesn't mean that per head of population it's growing. Why? Well, participation is quite good, actually. We've managed to maintain older people in the workforce longer than we expected. People are working longer. When I was first entering the workforce in the 1980s, there was a thing called early retirement. And your employer might, as a special benefit, give you early retirement. And you could go off and retire at 53, 54. That was considered to be a great benefit. What you did at 53 or 54, I don't know. Play golf, whatever you did. But that was sort of the idea of the day. And that was not good for participation. So participation, we've done well. Productivity, as I said, has not been good in Australia. And so per capita, we have not done well in the last year. So it is the productivity agenda that we have to reinvigorate. We know now the limits of monetary policy can only do so much. It's very blunt. So we've got to start doing the hard stuff now. And that's why it's been put off, because it is the hard stuff. And this is microeconomic reform, this is tax, this is competition policy, this is labour markets. These are all the areas where we did well in the 90s and the early 2000s, but we haven't done much since. And if we don't address that long-term challenge, if productivity declines, or even, well, if it grows slowly or even worse declines, then we'll be a bigger country, but per capita, we won't be a wealthier country. This is our problem at the moment. And we have to make sure that if we want rising living standards, can only be done off the back of rising productivity.
Historically, Australia's done very well as an exporter of natural resources. We're genuinely world-class in that area, and it's kept the Australian economy ticking over for decades. The current Treasurer has a view that Australia should become a renewable energy superpower. Could we get your thoughts on that, the likelihood of that prospect, please?
Well, look, it'd be great if we could do it, but I'd have to say to you, it's a long way off, because we'd have to become self-sufficient in renewable energy before we became a mass exporter. And I'm not saying it can't be done, but I would say to you, it's a long way off. And in the interim, the products that are contributing most to national income are our exports of iron ore and coal and gas. These are the things that we sell to the world, and we're doing very well. The prices for these commodities are extraordinarily high. They are, people don't realise this, these are the highest prices since the gold rush. We are in a terms of trade boom. The money we are getting for our exports compared to the money we are paying for our imports, that's the terms of trade. We're in a fantastic trading environment. What worries me is if that normalised, then we'd have some problems. So in the interim, and a lot of this depends on China, of course, we are getting fantastic prices for our mining commodities. One day, would we be able to get fantastic prices for renewable energy? Well, we might, but it's a long road and it's a long way off. And in the interim, we want to get many years, decades out of those other commodities.
Just final topic before we take questions on moving back to interest rates, monetary policy and so on. For a lot of young people, current level of interest rates and lack of supply of housing is a real issue for them. The people who see themselves perhaps spending their entire life as renters, for example. Do you have any advice for people in that situation? Obviously, over time, interest rates are going to go up and down. People's mortgage costs are going to go up and down. We've seen them go up lately. But for the younger people in the audience or listening who find themselves in that situation, what would you be saying to them?
Well, I would have been saying, and I was saying when the cash rate was 1.5%, this is not normal. Don't think this is normal. Don't stretch yourself on a 30-year mortgage thinking that the 1.5% cash rate is normal. When the cash rate went to 0.1%, I was saying it doubly. This is not normal. This is emergency levels. It's not going to last. When the bank was saying it'll last till 2024, I was saying the bank doesn't know. It can't possibly tell you what the rate is going to be in 2024. Build in a margin. It's not going to last. Now, the cash rate at the moment, you know how banks work. So it's the cash rate, which is set by the RBA, and then the banks will charge a margin above that. So, let's say it's 1%, 2%, something like that. So the cash rate is 0. A bank, you can get a loan out of a bank at 2%. The cash rate is 4%. Your loan out of the bank is going to be 6%. So the bank's going to charge a margin, say 2% on the back of the cash rate. Now, our cash rate is now 4.1%. Went from 0.1 to 4.1. So your mortgage basically went up 4%. when it resets. You might have been on 2, you go up to 6. If you're on 3, you go up to 7. Even at 4.1, that is lower than most of the developed world. The Americans are 5 and a bit. The British are 5. The Kiwis are 5.5. So think of that, 0.1. 0.2, even at 4, by historical standards, that's still not a peak. Now, some of us can remember when the cash rate was 17% back in the 1980s. So I'd say to people, when you're borrowing, you've got to factor in a mortgage is generally a 20 or 30-year obligation, and you've got to think to yourself, you're to write up the peaks and write out the loans. And of course, the banks are supposed to not lend to you any more than you'll be able to sustain. So I'd still be careful. Interest rates in Australia are still below comparable rates in other Anglo countries. Now we're sitting around, we're seeing whether inflation's going to come down. It looks like it's not rising anymore. But is it actually coming down? These are the things that we'll be following very carefully in the future.
We now do have time for some questions. If you have a question, if I could ask you to raise, we'll alternate between in the room and online. If you do have a question, if I could ask you to raise your hand, and if you could preface your question by telling us who you are, please. So happy to take questions from, we'll start with one in the room if there's a question from the audience. Sally?
Good morning. So lovely to see you. Thank you for those interesting comments, Peter. Sally Patford, Melbourne. I've got so many questions, but I'm going to start with one. Could you give us some of your forward advice by telling us what is the future fund investing in and where? I'm particularly interested in your view on this region.
Yeah, so well, the future funds invests a little over 200 billion. We invest both in Australia and outside of Australia, about 2/3 out of Australia, 1/3 in Australia. We invest in all asset classes, so public equity, private equity, credit, distressed credit, infrastructure, property, hedge funds. We published a report quite recently where we said we're not convinced the worst is over yet in equity markets. There was a big rally going up into June of this year in equity markets. People thought, oh, the worst is over with interest rates. We can now go back into equity markets. It was called the Goldilocks recovery. That we've been through too hot, too cold, and it's just right. Since then, the Goldilocks recovery has evaporated a bit. Markets have turned a bit sour. We thought that would happen. So we're diversifying as much as possible. And we take a big diversification in our asset allocation. The thing to watch, I think, in investment markets that could really affect Australia is China. A big part of our wealth in the last 20 years has been China, bidding up all those commodities I was talking about before. China is carrying a lot of debt. Some of its very big property companies have recently failed. If the Chinese economy were to slow and that played back into our commodity prices, that could have a big risk for us. First point. Second point, big trade wars going on between the United States and China. at the moment, which we will get caught up in. We are being caught up in. So I just, if you're thinking about it, China's been a great bet for a long time, but just look very carefully at China. I know in your City of Melbourne investment fund, you'll have holdings all over the world, but I just caution you to have a careful look at China at the moment if you're invested there.
We've got a question submitted online. The Reserve Bank of New Zealand has to explain the assessment of the effect of its monetary policy decisions on sustainability of housing prices. Do you think we might see the RBA required to do something similar here?
You see, I'm arguing for a narrow focus, or let me put it a better way, for a sole focus for the RBA, because I think if you're clear what you're asking it to do, you can hold it accountable. I think if you say, oh, well, you're responsible for inflation, and you're responsible for employment, and you're responsible for housing, and you're responsible for climate change, the bank will be sort of spinning its head. You won't really know how to hold it accountable, and you'll be asking the bank to do a whole lot of stuff that it can't actually do. Now, I would argue, yes, the bank, by controlling interest rates, can have an effect on housing affordability. But there are so many other things that affect housing affordability. Migration. Bank can't do a thing about migration. If the government suddenly brings a huge migrant inflow, housing prices are going to go up. What should the bank do? Taxation arrangements affect housing affordability. The bank got no control over taxation arrangements. So what should it do? Planning and land release affect housing affordability, right? Suppose our state governments say, you know, we're going to make it really hard to do development or land release. House prices go up. What should the bank do? What should it do? Cut interest rates? It's going to fix the planning problem. See, my argument is this is part of the problem. You're asking it to do too much. We've taken too much weight already onto monetary policy, right? And you give it these additional areas, you're going to be asking it to do stuff it can't do. One of the few things it can do over time, I should say, is control inflation. But if you confuse it with a whole lot of other objectives, I don't think it will do that well. So.
And some of them potentially in conflict as well, of course.
Yeah.
Take another question in the room if we have one. Yep, please.
Also with your, sorry, my name's Hannah. Also with your chart, your biggest holding is in your equities portfolio. As the chairman, are you concerned by their suggestion that any extra cost from the same pay, same jobs, they've said probably 1.3 billion is going to come from its dividend payouts?
Well, see, we would hold BHP more than any other stock because it's the biggest stock on the market. By and large, we hold the index. So our equities would just basically be held in accordance with the market cap of the various companies. Look, I wouldn't comment to you particularly on BHP, but you know, I would say to you that we do have a productivity problem in this country, and we should be doing as much as we can to boost productivity. You have to ask yourself whether this proposed new legislation is going to boost productivity. Now, I haven't seen any evidence that it will. And I'm in favour of structural reform, including in labour markets, that boosts productivity, not just for BHP, but for every other company in the economy.
We have another online question. Based on Australia's history of riding out events, such as the Asian financial crisis, which of course you were in government at the time, and the GFC. Do you have any views as to what led the RBA to treat the economic impact of COVID differently?
Well, see, in fairness to the bank, and it says this, we go into a pandemic. We haven't seen a pandemic since the Spanish flu of the 1920s. And the bank feels we've got to do everything we can. Now, can't cut interest rates by that much because they're almost at zero already. So it tries to do these other things, which it wasn't experienced. We're failing. I'm not criticising the bank for cutting rates. I just think going beyond that, it wasn't experienced and it didn't work. So, look, it tried to do everything it could. It may have overestimated in hindsight the effect of the pandemic, but it wasn't the only one. I mean, we were being told that there were going to be temporary morgues all over the city as the bodies piled up, and fortunately, none of that happened. So it probably overreacted a bit, but it wasn't the only instrument that overreacted. I believe the state governments overreacted with their curfews and the like. And this is not hindsight. I mean, I was actually arguing at the time that that the forward guidance was wrong. So perhaps they overestimated the effect of COVID. They weren't the only ones. But I do feel that by going into these new areas where they weren't experienced, they'd never done it before, where they did make mistakes, it was a very dangerous policy. That's my opinion.
Yeah, we also got a very effective vaccine very quickly,
Yes.
and things worked out better than they could have done. Yep. Exactly. We'll take another question in the room, please. Yep.
Yeah, hi, I'm Nisha. What is your view on stage 3 cuts and what role they will play in Australia's future?
Well, the stage 3 cuts are tax cuts we're talking about here are a part of tax changes that were enacted by the previous coalition government. Stage 1 and stage 2 were to deliver tax reductions to lower middle income earners. Stage 3 are part of the package. If you separate them off, people say, oh, that's going to go to middle and upper income, but you've got to remember that middle and lower incomes already had their tax cuts. So I think the stage 3 have to go ahead. That's part of the whole package. And the point I'd make is this: when you call them tax cuts, let's be more precise here. We are returning a portion of bracket creep. Nobody's actually going to get a cut out of that. You're going to get back a little bit of what the extra tax you're paying as a result of your wages pushing you into a higher tax bracket. So compared to my day, taxes per capita are much higher today. And the tax-free stage 3 of the tax cuts won't return all of that bracket creep, not by a long shot.
Another question online. Private investors are being held responsible, by some at least, for housing availability problems. Negative gearing issues like that get raised continually. Does that sound right to you?
Well, you see, this is my point. If you were to abolish negative gearing now, you probably reduce the supply of housing, right? And that's why I think that's gone off the agenda. We all know there's a housing shortage, right? So would it make sense to increase taxes on private owners of rental housing? Would it, at a time when we've got a housing shortage? I think there are two things that are really driving it at the moment. And the first is obvious. I don't know why people don't talk about it more. We're bringing in something like 400,000 migrants this year. 400,000. I think the number of approvals for new construction of units is something like 7,000 or 8,000. Do the math.
And talking about rental caps and all kinds of...
Do the math. you know, 400,000 people got to live somewhere, right? And we can't construct 200,000 homes or units in a year, nothing like it. You know, you got to have the land release and the zoning approvals and planning and approvals and the this and that. Is it any wonder that you have a shortage and B, affordability? Now, I think this is the interesting point. Why is it that the property market didn't fall more with these interest rate increases? And that's because demand is so strong at the moment. Now, you know, I'm in favour of a good migration program, but when I was in government, I think we used to have 120,000, 400 in 1 year. It's a lot of people.
Okay, we'll take another question in the room if we have one. Yep.
Thank you.
I agree totally with your points about productivity growth and the importance of productivity growth. In fact, in the speech of Phillip Dolan, which you mentioned earlier, it was interesting that the governor of the Reserve Bank would say that productivity growth is central to our future prosperity. Now, we've got a productivity commission that's just come forward with 71 proposals as to what should be done to increase productivity, and to me, just about every one of them looks thoroughly sensible. But they do run into the problem that you mentioned, that this requires structural reform. And how do you respond to structural reform? You go ahead with it with a strong government, or you do what the ACTU has requested, get rid of the productivity commission. The other option is the current Treasurer says we really have to rethink the role of the Productivity Commission. Now, it's been successful ever since the tariff board. It'd be really interesting, since the Productivity Commission was created on your watch, and I imagine the present Treasurer, you'd be the first person he'd go to ask for advice on how things should be reformed.
Yeah, well,
I don't really, but anyway.
Well, breath.
You see, so you said, as you said, you know better than me. We had a thing called the Tariff Board, then we had a thing called the Industry Commission, and then as tariffs, by and large, removed, we could have sort of packed up and gone home. And I said, no, we want to widen this out, and we want to invigorate the productivity agenda. And I reconstituted it and named it and appointed people, and we call it the Productivity Commission. And as you know, it was always an advisory body, evidence-based advisory body. Very important, evidence-based advisory body. But it's up to the government, as it was with the tariff, whether or not to accept the recommendation. And you know, if there's no one there that's grabbing hold of this and saying, yes, I want to do this, yes, it's really important, its reports just gather dust up on a bookshelf somewhere. And you really do need people that are prepared to drive this. I mean, you don't have to neuter the Productivity Commission. You can just ignore it. And, you know, I'm sure if you went back through, you'd find lots of great reports from the Productivity Commission, but how many over the last 15 or so years have actually been acted on? So they can keep on writing their reports, and I hope they do, because it contributes to public discussion. But if no one's prepared to grab hold of it and do the hard yards, I've got to say, as hard yards, we were discussing earlier, when we were doing competition policy, I spent years negotiating with newsagents, pharmacists, the New South Wales rice growers, you know, trying to eke out productivity improvements. Gee, it's hard, I'll tell you.
One point that was important earlier on was bipartisan support for things like phasing out the 8 motor vehicle producers at the time of the Hawke Keating government. But it seems that bipartisan support is not there anymore.
Well, I say it's bipartisan, but it's probably bipartisan
In the wrong direction.
in not acting on many of these things. It's very hard to do micro reform. You see, come back to one of these questions. Should we ask the Reserve Bank to deal with housing affordability? And I've mentioned all the things I think affect housing affordability: the migrant intake, the planning rules, the taxation, probably the labour relations. Because that's all really hard, we'll ask the Reserve Bank to deal with affordability. Right? This is what's wrong here. This is an example of taking the weight off the people who are responsible and trying to put it onto somebody who can't possibly deal with it. And as what I was saying earlier on, because monetary policy is easier than legislative reform or administrative reform, it's kept loading up that agenda and vacating the field out of the legislative. And I want to push back on that, and I want to say, okay, Reserve Bank inflation target, housing affordability, state governments, federal governments. I want to push back on that, and I want to try and hold responsible the people who do have the powers, because in the end you'll end up giving every responsibility to the Reserve Bank, which won't be able to do anything. And what will the government do then? What? See, it's horses for courses. So this is my point. Don't ask an institution to do something it can't do, just because the institution that is responsible won't do it. That's my big theme for the day.
We've got time for one last question. Returning to the topic of monetary policy, this is an online question. Poor wage growth has been an issue, and in particular for younger Australians. How do you think monetary policy influences that? And again, advice for young people who are listening or in the audience today.
You see, again, I don't think monetary policy has got a lot to do with wage growth. So again, my point, we're going to ask the Reserve Bank now to get wage growth going. It can't do that. And the only, I thought there was a news flash coming in. The only way that long term we can maintain increases in real wages is by boosting productivity. It's the way we did in the past. It's the way we'll do it in the future. Now, if our productivity is going backwards or not growing fast, we say to the Reserve Bank, "Oh, we'll help with wage growth." How would the Reserve Bank help with wage growth? Again, I think it's asking too much of monetary policy. I think wage growth will come out of productivity. Productivity will come out of all of these things we're talking about: labour relations, taxation, microeconomic reform, energy policy. All of these things, you have to make your economy more efficient, and then we can afford to pay ourselves more. And during my period in office, inflation was low, 2 to 3%, but wage growth was generally 3 to 4%. We were getting real wage increases. The problem at the moment is inflation is high, 6 or 7%, and wage growth might be 3 or 4. You're falling behind in real terms. And even if you got it to 6, you still wouldn't be improving. So that is a problem. And again, horses for courses. How are we going to fix that? Don't ask monetary policy to do it, would be my advice.
Okay, we're out of time for this part of the today's proceedings. I'd ask Coron if she would please promote a vote of thanks to Peter and to close the proceedings for us.
Thank you very much, Phil. I have a burning question on my lips, Peter, that I've resisted from asking, so this might be for breakfast, about whether the decision to refuse Qatar to allow extra flights into the country is in the national interest, but let's reserve that one.
Won't take long to answer that.
No, right. Peter, you've absolutely treated us to your characteristic, straight-talking, hard-hitting style of commentary on, you know, the things that really matter in our economy and our society. So you haven't lost any of your edge, Peter, and we are just so privileged to have been able to benefit from that. I've got 3 Ps for you. Not as poignant as yours, but certainly pertinent, perceptive, and provocative, the comments you shared with us this morning. So huge thank you. It's our great pleasure and our privilege here at Melbourne Business School to be able to attract and bring and share with you people of the caliber and experience that we've had the pleasure and privilege of hearing from this morning. And it's thanks to you that we can have such a stimulating and engaged discussion. Thank you also, Phil, for moderating the proceedings, and thank you to all of you for being here. We'll send you off on your way, but not before hopefully you've had some breakfast and some sustenance to keep you going. Wish you all the best into the day. We'll close the proceedings there. Thanks.